Markets are very clearly responding or expecting continuity as far as the government is concerned. So obviously there has been a good rally over the last 1 month ever since the elections were announced, and markets want the government to continue. Having said that, if you see in the past, elections have had knee-jerk reaction on the day of the election verdicts, but eventually markets sort of stabilize, and it's always linked to the economy growth. So our view is that only in the rare circumstance of a very fragmented verdict where we don't know who's going to be the prime minister and who's going to form the government, the market might take it really badly. Otherwise, we believe that the volatility this time on the day of the election results is going to be much lower than what we have seen earlier. We continue to be quite positive on the markets, and very clearly, again, markets have given decent run up to the elections, and it makes sense to believe that the next 2 to 3 weeks markets are going to be quite range bound with bouts of up move as well as down move. The trend in the near term is going to be dictated by the exit polls and then by the final verdict. Our view is that we don't see a major disruption post election, and from our fund perspective, we are already 2/3 invested, and we would be around 75 to 80% invested before the election. So I would say that stay invested would be our investment strategy. The markets are expecting the earnings to move up, but that has been the case last 2-3 years, and the earnings have not sort of kept pace with the markets. Having said that, I think this time, particularly because of the huge swing in the profitability of corporate banks, you might see decent earnings growth as far as the Nifty is concerned. So we expect 17-18% growth in Nifty for 20 as well as 21, largely led by the corporate banks. Another joker in the pack is metals, and they also cause huge swings in the profitability. So for March 19, for example, metal companies are expected to report lower profits. So they might drag down the overall profit growth for 19. So for 20 and 21, we have to see how the metal companies pan out. The one thing to note is that the last 3-month rally has also been a global rally. So it's been a risk on trade globally, with US dollar at the margin weakening and money flowing back to emerging markets, of which India has been a beneficiary. My view is that this flow into emerging market and India should continue for the next 1 year at least, unless there is a catastrophe as far as elections are concerned, and that should hold the markets in great state. The biggest risk to market, obviously, as I mentioned earlier, is a very fragmented verdict as far as elections is concerned. Very clearly, the sectors which would be most vulnerable would be the high beta ones. So we have seen a huge move up in the financials. We have seen some decent move up on the capital goods side. Largely, sectors which would be linked to the growth in the economy would be the most vulnerable in case there is a sort of a verdict which is not liked by the markets, and these would be the sectors which would be most vulnerable. And there are some business groups which are known to be closer to one party vis-a-vis the others. So as happens in all election verdicts, those groups which are known to be closer to one party versus the other would also be vulnerable in case the verdict goes against that particular parties. We clearly see good pockets of value. In fact, we have done a detailed analysis, and what we have seen that over the last 15 months to 18 months, mutual funds and investors have vacated 2 interesting spaces. One is companies below 5,000 crore market cap. So if you actually look at the total AUM which mutual funds manage in equity, they manage almost 10 lakh crores. And only 6.5% is invested in companies below 5,000 crore market cap. Also, high net worth individuals, as well as so-called the alternatives, they have also vacated this small cap space because returns have not been great over the last 12-15 months. Our view is that there is huge opportunity there because their companies are still trading at 8, 9, 10 P and growing quite decently. The second place where we see a lot of value is again based on this data. Almost 40% of all investments done in equity mutual funds is in companies with a trailing PE of more than 30 times. So our view is again, companies which have so-called been growing without any concerns, they have got disproportionate re-rated and they are trading at very, very high PE multiples. But we have seen the first sign of them also not performing. We have seen large companies like Maruti, Eicher, Page, where slightest disappointment on earnings has caused the prices to go down by 25-30%. Our view is that again, a value with reasonable growth is a space where the markets have completely vacated that. And therefore our view is that follow a 15-15-15 kind of a system where companies which are growing at 15% with an ROE of 15% and with a likely PE of less than 15. I think that is the space where investors should focus on. In terms of sectors, again, discretionary consumption is more, I would say, good to invest rather than staple consumption. On the economy side, our view is that already a lot of work is being done on the infrastructure space. Going forward, it will only increase because the manifestos of both BJP and Congress highlight the huge infrastructure spend which they are focusing on. So EPC companies for the first time are now looking good even on a ROE basis. So I mentioned 15%. A lot of these EPC companies for the first time are reporting ROEs of 15 to 18%. So that would be good space. Similarly, there are some smaller cement companies which have decent profitability even now with good ROEs. Even they should be clearly focused on. It's a consensus trade, but we still believe that corporate banks, particularly the larger ones, are good sectors. We also like select life insurance companies because we do believe that it's a structural run. I mentioned to you about the discretionary spending. So there are a few homegrown brands which are on the sort of the smaller to mid-cap side. We like that. Companies on the infrastructure side which are also focusing on the railways because a lot of work is being done there. I would bet on those kind of sectors too.